welcome to the Deep Dive. We're kicking things off today by looking at something that's been creating, well, a surprising amount of buzz in the investment world lately. Stock splits.
Yeah, it's kind of funny, isn't it?
Seriously, in 2024, the excitement around these was apparently second only to the massive wave around AI.
It really is interesting how a move that doesn't fundamentally change the company can, generate so much attention.
So what exactly is a stock split, for anyone who might be unsure?
Okay, so basically a company is increasing the number of its outstanding shares while at the same time decreasing the price per share by that same factor.
Right.
So like if you had one share worth, say, $200 and they did a 2-for-1 split, you'd end up with two shares, but each one would be priced at $100.
So the total value stays the same.
Exactly. Your investment value doesn't change. The company's overall market cap stays put. It's really like swapping a $20 bill for two tens, no real change in value.
Right. It's more about how the pie is sliced, not the size of the pie itself.
Well,
But here's where it gets really interesting, I think. Historically, companies that do what's called a forward stock split.
that's the one that lowers the share price.
Exactly. Those companies have actually tended to outperform the market afterwards. There's some Bank of America global research data looking back to 1980.
Okay.
It shows these companies averaged a 25.4% return in the 12 months right after announcing the split.
Wow, 25%. That's quite a bit higher than average.
Yeah, it's more than double the S&P 500's average annual return over that same period. So today, we're digging into a Motley Fool article that points to one stock split stock as maybe a compelling buy this May, and another one they suggest you might want to avoid.
Okay, got it. So sort of a compare and contrast.
Exactly. Our goal here is to give you a clearer picture of what's behind these recommendations.
Makes sense. And the article points to O'Reilly Automotive as the potential buy and Arista Networks as the one to maybe avoid.
That's right.
So let's start with O'Reilly. Why is it being flagged as what did they call it, a supercharged buy?
Okay, let's dive into O'Reilly Automotive, ticker ORLY. They were one of the first really high-profile companies in 2025 to announce one of these forward splits.
Okay.
They announced it back on March 13th, laying out a planned 15-for-1 split.
15-for-1, that's a big one.
It is. And assuming it gets the green light from shareholders, they vote May 15th, it should take effect after the market closes on June 9th. That takes their share price from nearly $1,400.
Wow.
Down to around $90 a share.
Okay, and that $90 price point is pretty significant, right, for retail investors.
How so?
Well, think about it. For anyone whose brokerage doesn't offer fractional shares, buying just a piece of a share coming up with almost $1,400 for a single share is, it's a big hurdle.
Sure, that's a lot for one share.
But post-split, when it's around $90, suddenly it's much, much easier for more people to actually start a position or add to an existing one. It just lowers that barrier to entry quite a bit.
Absolutely. Definitely brings down that maybe psychological barrier too. But beyond the split itself, the article digs into some really compelling underlying reasons for O'Reilly's potential.
Like the fundamentals of the business.
Exactly.
Yeah.
And the big one seems to be the simple fact that cars in the U.S. are getting older.
Ah, right. The average age keeps ticking up.
Yeah, there was a May 2024 report from S&P Global Mobility. It said the average age of cars and light trucks hit an all-time high, 12.6 years in 2024.
12.6 years, wow.
Which is up quite a bit from 11.1 years back in 2012.
And older cars just mean more business for auto parts stores, right? It's pretty straightforward.
Seems like it.
As vehicles age, they need more maintenance, more repairs, sometimes more complicated stuff breaks down. That creates this steady, even growing demand for the parts O'Reilly sells.
And it's not just more repairs, maybe more expensive ones too.
Could be, yeah. Older cars sometimes need those, higher margin components replaced. So that directly helps O'Reilly's bottom line.
And another point the article makes is that O'Reilly seems kind of insulated from economic downturns, even tariffs.
How does that work?
Well, think about it.
Yeah.
Economy slows down. What do people do? They often put off buying big-ticket items, like a new car.
Right. They decide to just keep their current car running longer instead.
Exactly. Which means more repairs, more maintenance, more business for O'Reilly.
That makes sense. And the tariff angle.
Same idea, really. If tariffs make new cars more expensive, that just gives people another reason to, fix up the car they already have.
Good point. So it's sort of recession-resistant, or at least recession-resilient, maybe tariff-resilient too?
Seems that way.
Yeah.
Plus, O'Reilly apparently has a really efficient system for getting parts where they need to go. They've got, 31 distribution centers,
Okay.
feeding into nearly 400 hub stores. It's a hub and spoke model.
Right, I've heard about that. So the hubs stock more stuff.
Yeah, and this setup lets them deliver a huge range of parts, something like 153,000 different SKUs,
That's a lot of parts.
to their regular stores really quickly, often same day or overnight. That's going to be a big advantage.
Oh, absolutely. In the auto parts business, speed is critical. Mechanics need parts now. Car owners don't want to wait. A fast supply chain means happy customers, repeat business. It's key.
Okay, and one last thing for O'Reilly. The article highlights their share repurchase program. Sounds pretty aggressive.
Share buybacks? Okay. What are the numbers?
Since 2011, they've bought back, get this, $25.94 billion worth of their own stock.
Wow, nearly $26 billion.
Yeah, and doing that has apparently retired almost 59.4%, to be exact, of their outstanding shares. Why is that such a big deal?
Well, think of it like slicing that company pie again. If the company's making steady profits or growing profits, like
Right.
O'Reilly has, and they shrink the number of slices, the number of shares out there, then each remaining slice, each share, represents a bigger piece of the total profit.
So it boosts earnings per share.
Exactly. It directly increases earnings per share, or EPS, which is something investors watch very closely. It can be a really powerful way to return value to shareholders over the long term.
Okay, so that paints a pretty positive picture for O'Reilly, based on the article. Now let's flip the coin and look at the stock they suggest avoiding. Arista Networks, ticker ANET.
Right, Arista. They also did a split, didn't they?
They did, a 4-for-1 forward split. It was announced November 7th, alongside their Q3 results, and the shares started trading split-adjusted after the close on December 3rd, 2024.
And that took their price down too, obviously.
Yep, from nearly $422 down to around $105.
Okay, so here's the interesting contrast, right? Both companies did forward splits, which historically correlates with outperformance. But the reasons for caution with Arista seem quite different from the bullish points on O'Reilly. It really underscores that the split itself isn't magic.
Definitely not. It's about what's happening with the company around the time of the split.
Exactly. You got to look at the bigger picture.
And the article does give Arista credit where it's due. They acknowledge the positives. Arista is a huge player in, well, the whole AI revolution, right?
Yeah, their networking gear is crucial. It connects all those powerful GPUs and servers that make AI data centers work efficiently.
No, they're definitely benefiting from that massive build-out of AI infrastructure.
Yeah.
It's undeniably a hot sector.
It absolutely is. And Arista's numbers have looked good. They've shown really strong sales growth, nearly 20%, and their service revenue, that really jumped in 2024, up 35% to over $1 billion.
$1.12 billion.
And with a really high gross profit margin on that service revenue, too, like 81%. So on the surface, looks pretty good.
But there's always a but, isn't there?
Seems like it in this analysis anyway.
The article raises some potential red flags, some reasons for skepticism about the near term. The first big one is the worry about an AI bubble bursting.
The B word, bubble.
Yeah. The article points out, historically, almost every major new technology goes through this phase, an early bubble that pops.
The dot-com bust being the classic example.
Right. And there's no guarantee AI will be different. The fact that maybe most businesses are still kind of figuring out how to actually use AI effectively, how to get a real return on those big AI investments.
That could be a warning sign.
That's the concern raised, yeah. You mentioned tech bubbles before. What are some things you see with AI now that kind of echo those past situations?
Well, it's often about expectations getting way ahead of reality. You see this huge surge in investment, massive enthusiasm, stock valuations soaring, sometimes before the technology is widely adopted in a profitable way across many industries. With AI, the potential is clearly enormous long-term, but is the current market valuation reflecting that future potential plus some extra hype? If widespread money-making applications haven't quite caught up yet,
Then the valuations might be too high for the current reality.
that's the risk, yeah. Expectations might need to reset, which usually involves prices coming down.
Okay, so that's the AI bubble concern. But it's not just that. There are also worries about macroeconomic factors, the bigger picture.
Like the overall economy.
Exactly. The article mentions the Atlanta Fed's GDP Now model. It's like a real-time tracker for economic growth. And as of late April, it was projecting a pretty significant decline for the first quarter U.S. GDP, like 2.4%.
Oh, decline. Wow. Okay.
Yeah, And the article notes that if that happened, it would be the worst quarterly contraction we've seen since the Great Recession, if you exclude the, pandemic shock.
So how does a shrinking GDP potentially hit a company like Arista? Well, think about their customers. A lot of them are big companies building out data centers. If the overall economy weakens, businesses tend to get more cautious with their spending.
Right, they pull back on big projects.
Exactly. Those major investments in new networking gear, data center upgrades, those might get delayed or scaled back if companies are worried about an economic slowdown. And that would directly impact demand for Arista's products, potentially slowing their growth.
Okay, makes sense. And the final point of concern mentioned is Arista's valuation. Even after the split, even after maybe some price dips, the stock still trades at a pretty high price-to-sales multiple.
Price to sales, or PS, what level did they mention?
North of 14. The article suggests this still leaves the stock kind of vulnerable, potentially more room to fall.
Yeah.
What does a PS over 14 really tell us here?
So a high PS ratio basically means investors are willing to pay a big premium for every dollar of the company's sales, not even profits yet. Usually that premium is based on really high expectations for future growth.
Okay.
Arista is definitely in a high-growth area, and they've shown strong performance, no doubt. But a multiple that high suggests a lot of future success is already baked into the current stock price.
So if anything slows that growth down.
Right. If growth falters even a little bit, maybe because of that AI bubble risk, or the macroeconomy slowing down the market might suddenly think, whoa, maybe that premium wasn't justified. And that can lead to a pretty sharp price correction.
Got it. So pulling it all together,
Yeah.
we've got O'Reilly on one side. Seems like a potentially more stable bet, driven by these fundamental trends like aging cars, plus their history of rewarding shareholders through buybacks.
Right. More of a slow and steady, fundamentally driven story, perhaps.
And then there's Arista. Definitely in an exciting, high-growth tech space, but maybe facing some significant risks related to potential AI overvaluation and those broader economic headwinds.
A higher growth potential, maybe, but also carrying higher risks, especially in the near term, according to this analysis.
Precisely. And I think the key takeaway here for you, the listener, is that while these stock splits get headlines and can sometimes create a bit of positive buzz,
They aren't the reason to buy or sell a stock, not on their own.
exactly. It's the stuff underneath the strength of the business, its future prospects, the economic climate, the valuation that really drives long-term investment success or failure. The split itself is more like window dressing.
Well put. It might make the stock look more accessible, but it doesn't change the underlying value or risk.
Right. And on that note, here's maybe a final thought for you to chew on. We heard that historical data suggesting companies doing forward splits tend to outperform afterwards. So thinking beyond just the split itself, what other underlying business qualities or maybe specific market conditions might signal a truly great buying opportunity when you see a split announced? Or conversely, what might signal that maybe it's time to sell, despite the split?
That's a good question to ponder.
Definitely something to think about. We encourage you to always dig deeper than just the headline news of a stock split when you're making your own investment decisions. Thanks for joining us for this deep dive.